again, we've been going through the accounting cycle, and we've been spending our time on the first three steps, where we're journalizing on a daily basis the chronological listing of all the things that happened to the business. In other words, dear diary, the following things happened at work today. The second step was to take those journal entries and to post them or copy them into the ledger. And we know our ledger is T accounts, where we can group together debits that pertain to a certain account together, the credits that pertain to a certain account together. So it's the same information as the journal. It's just, instead of being chronological, it's by type of entry, by type of account. The third thing we do is we do the trial balance to make sure we can copy correctly. So before we start on what you then do, which is at the end of the period, let's review quickly. So what do you know so far? We know that assets equal liabilities plus shareholders' equity plus revenue minus expense. We know that revenue minus expense, if we were to do it in a beautiful financial statement, is the income statement. And we know that assets equal liabilities plus shareholders' equity in beautiful financial statement form is the balance sheet. And we also know that the link between the two is shareholders' equity that we do at the end of the period. We also know our debit and credit rules. We know that assets are increased by debits, decreased by credits, and expenses act like assets. They're increased by debits, decreased by credits. The rest, revenue, shareholders' equity, and liabilities, act the exact opposite, and they do because these wonderful plus signs in between them show that they're alike. The other thing we know is the accounting cycle. And we know so far that on a daily basis, we make journal entries, or JEs. We post them to T accounts, which is the ledger, and we do a trial balance, which proves that we can post debits as debits and credits as credits. At period end, we have to do a little house cleaning it up a bit. So we will be preparing adjusting journal entries. Adjusting journal entries. And there's 4 kinds. So let's take a look at what those adjusting journal entries are. But first I need to remember that if I prepare adjusting journal entries, I also need to post them and then do a trial balance again to prove that I can copy debits as debits and credits as credits. So why are we making adjusting entries? Why are we making this complicated? Well, the reason is because when we deal with corporations, we don't use the cash basis. So, no cash basis. You and I are cash basis. We recognize revenue when we receive the cash. We recognize expenses when we pay the cash. But that is not true for a corporation. They're very interested in the timing of the revenue and expense recognition, and they try to accurately measure the revenues when it's earned and the expenses when they're used, not when you pay for them. So accrual accounting income statement attempts to match the revenues earned and the expenses when they're incurred or consumed, but is not looking at the cash implications at all. There's another statement for that called the statement of cash flows. So don't worry, Cash is important. It's the blood of business, and we will turn our sights on it when we look at the statement of cash flows. But right now, what we're trying to look at is the matching of effort and benefits from those efforts. The effort is expired or consumed costs, which are expenses, and the benefits is the sales or the revenues. Now there's 4 kinds of adjusting journal entries, and I'm just going to briefly talk about them here and tie it to what you see in your book. There are accruals and there are deferrals. Deferrals means that something is already sitting in an asset account and it needs to be moved to an expense account in the adjusting entry. The question here is, what has been used or consumed? So that's one kind of deferral. The other kind of deferral is sitting right now in a liability account, and that liability account, like unearned revenue or deferred revenue, says that we have taken cash and we're responsible for that cash until such time as we produce the good or the service the customer has asked for. So we're going to be moving from a liability account to a revenue account. So the question here is, what has been earned? So notice in both of these, cash has already happened. In other words, we have already paid for the assets, or we have already received cash from our customers. The other 2 types of adjusting entries are accruals. There is no cash yet. So the first one is what I like to call expense now, pay later. And I like to call it expense now, pay later because it always debits an expense and credits a payable. The other one is receive the cash, receive later, but it's revenue now. Because we always debit a receivable and we always credit a revenue. So let's take a little bit deeper look into these and give you some examples, and then we'll do a whole bunch of them. All right, so at the end of the period, we're going to look at those deferrals. And good examples are supplies. So we have an asset account called supplies. We look at that account and say, well, how much of those supplies have been used or consumed during the period? And thus we need to move it to the expense. And the entry is debit supplies expense, credit supplies. Or we could have prepaid insurance or prepaid rent, where we have an asset account called prepaid insurance, that we paid for that insurance policy in advance. Well, some of that insurance has expired because insurance expires every day. So we're going to debit insurance expense and credit prepaid insurance. The other one that's down here is depreciation. And we already know that entry because it's debit depreciation expense and credit accumulated depreciation. And if you don't know that, you got it, dead, because you always debit DE and credit AD. More on that in a little bit. Other deferrals are where we're looking at a liability account and going, some of that unearned revenue, remember Delta and my plane tickets? Because I have a lot of unearned revenue that's sitting in Delta because I had to cancel a whole lot of planes. And I need to go fly because Delta has promised me plane rides through 2022. I can't wait. So I'm looking at the unearned or deferred account, and I say, how many plane rides have I given? And we need to recognize that piece of the revenue. So it's debit unearned plane tickets, credit plane revenue for how much has been earned. Now, the accruals, remember we said that's expense now, pay later? These are things like income taxes. When we talk about income taxes, remember that you owe it at the end of the year, but you don't have to pay it till you file your taxes. So if I'm preparing a financial statement on December 31st of one year, I need to recognize the income taxes that I owe for that year, even though I won't pay for them until later. So it's debit income tax expense, credit income taxes payable. Also salaries. If you think about salaries, remember there's a lag between when you work and when you get those paychecks. So again, if it's at the end of a period, I'm going to recognize the salary expense for the employees that have worked through the end of the year, but I won't pay them for another probably 15 days. Same thing with wages. Wages is like salaries. Property taxes is another one. Again, property taxes you owe each day that you occupy your property. And so, but you only pay your property taxes, I pay them 3 times a year. So I would debit property tax expense at the end of the year for the amount of property taxes I owe, even though I won't pay those property taxes till later. Credit property taxes payable. The last kind is that receive later, revenue now, where we debit a receivable and credit revenue. The interesting ones here is interest on a note receivable. So if you've got a savings bond or anything like that, you earn the interest every single day, but you won't receive that interest till you cash in that savings bond. So it's debit interest receivable, credit interest revenue. Also, if you've earned revenue through the last day of the year, even though I haven't sent the bills to the customers yet, I've still earned that revenue. So I'm going to, at the end of the year, debit accounts receivable and credit sales or revenue because I've earned it. So let's see if any of this stuck by looking at some accounts. So let's look at these accounts and see what kind of adjusting journal entry it is. So if I'm debiting expense and crediting a payable, what do you think that is? Since we're supposed to decide whether it's an accrual, expense now, pay later, or if it's one of those moving it, well, I think it's an accrual, don't you? Because we haven't paid the rent yet, so we haven't paid the cash yet. So cash is a future event, it's an accrual. Whereas debiting insurance expense and crediting a prepaid, that's where we're moving it from an asset to an expense because we've used it or consumed it, and that's called a deferral. Well, depreciation, D-E-A-D. If you don't know this, you're dead. That's right. We're moving some of the cost of that equipment into an expense because we've used or consumed it. So that's another deferral. Debit a receivable, credit revenue. That's an accrual, isn't it? Where cash hasn't happened yet. We'll receive the cash later, but it's revenue now. And the last one, debit a liability and credit a revenue account, is an deferral. So here's a problem where we had to figure out what we just did. So hopefully we did it correctly. It looks right, don't you think? All right, here's another one. Here we're actually going to be preparing the adjusting journal entries, and so you can kind of see how these problems set up. So notice it says that the supplies account, and we know supplies is an asset, so this balance of 85,000 would show up on the debit side, and that balance represents all the supplies in the supply cabinet. A count of the supplies reveals that the company actually had 30,000 of supplies on hand at the end of the period. So what it's saying is we need to move things from that asset account, supplies, into an expense account called supplies expense, don't we? Because we want the balance in supplies, the asset, to only be 30,000, because that's all the supplies that are on hand. So we need to make an adjusting entry to get it out of the supplies account because it's been used. And we'll do that on the next slide, but I just wanted to talk through the wording. Here's another one. As of December 31st, the company had not paid the rent for the month. Do they owe the rent for the month? They sure do. Have they used the rent for the month? They sure have. So we need to, and notice that we're not paying the rent here. We're just going to have an expense that we're going to pay later. So that's one of those accruals, isn't it? Expense it now, pay it later. Rent expense, rent payable. Notice in these accruals that nothing is in our accounting records yet. It's just telling us we've used or consumed something and that we need to recognize that we owe for it. In Part C, it says we collected 18,000 in customer advances. So that means it's in unearned revenue, which is a liability account, and liabilities have credit balances, because when we collected it, we debited cash and we credited unearned. Now it says as of the end of the year, 2/3 of the service have been performed. So 2/3 needs to move over into revenue. And the final one is the total cost of fixed assets is 500,000. It estimates the assets have a useful life of 10 years, and we use straight line depreciation. That means that if you don't know this, you got it, dead. So here's the actual adjusting journal entries. With the supplies, the difference between 85,000 and 30,000 is the 55,000 that has been used. So debit supplies expense, credit supplies for what has been used, or the 55,000. For the second one in B, the amount of the rent that is owed, but we'll pay it later, is debit rent expense 2,400, credit rent payable. As far as earning 2/3 of the services, if we have a balance of 18,000 and we've earned 2/3 of it, That's $12,000. So I'm going to take $12,000 out of the unearned revenue account and instead increase my revenue by $12,000, or 2/3 of the unearned. That means still we have $6,000 still unearned, still in the liability account. And in D, debit depreciation expense, credit accumulated depreciation. Since it's straight line 10 years, we'll take the cost of the fixed asset, $500,000, divide by 10 years, so it's $50,000 a year. Let's do some more. Here we have the company borrowed $10,000 at an annual interest rate of 12%. The first interest payment will be due on January 1st. We are on December 31st, 2017, excuse me. So we need to accrue the interest from July through December. Notice nowhere on the books have we recognized any interest yet, so it's going to be debit interest expense because it's a note payable, credit interest payable. The amount, if you remember your math, is principal times interest rate times time. The principal is $10,000. The interest rate is 12%, and the time is half a year. And principal times rate times time, that would be $600. The company placed several ads in the newspaper during the month. So have we used the newspaper services? Yes. On December 31st, the company received a $28,000 bill for the ads, which was not recorded at the time. Do we still owe? Notice we haven't paid this bill yet, but do we owe for the bill? Yeah, because it's advertising expense because we've used or consumed it, and it's advertising payable because we'll pay it later. It's one of those accruals, isn't it? Expense it now, pay it later. And the last one on this page has to do with the company paid a premium for a 1-year life insurance policy, and when it says that the premium was capitalized, that means it was an asset. We put it into prepaid insurance when we bought that policy. So what we need to do at the end of the period is to move it out of prepaid insurance. So that'll be my credit, and I'm going to debit insurance expense. Now, since it's a $350 policy, we bought it on July 1, it's half a year, so if I divide by 2, 6 months have been used, or $175,000. How are we doing? Here it is again. Same slide, just confirming we know what we're doing. Oh, this one looks hard. The print's smaller. So we have, and before we do it, let's see if we can see if there are accruals or deferrals. Here we have office supplies, so we immediately know it's in an asset and it's going to go into an expense account, where we'll debit office supplies expense, credit supplies for what has been used or consumed. Depreciation, we know that that's moving from an asset to an expense. If you don't know that, you're what? Dead. You're right. Property taxes for 6 months are estimated, meaning we haven't paid anything, and there's a big tip-off here because it says they've been accrued but not yet recorded. So that's one of those accruals where we expense it now and we're going to pay it later. Unrecorded means nothing has been recorded yet. So if that's the case, then we have another accrual where we're going to receive it later, but it's going to be revenue now. Unearned revenue. Unearned revenue, we know that to mean that we're going to move it from a liability account into a revenue account, so it's one of those deferrals. And services totaling 400 have been performed, but the customer has not yet been billed. So again, that's an accrual, isn't it? And it's an accrual where we're going to have to debit a receivable, and we're going to recognize the revenue now. So let's see how they set up as journal entries. So let's see what these actual adjusting journal entries look like. It tells us that at the beginning of the period, we had a beginning balance in supplies of $168, and then we went out and we purchased $830 worth, and when we purchased them, we debited supplies, credited cash. Now we're at the end of the period, and there's $570 of supplies in the supply cabinet. So we must have used 428. So if we've used them, we're going to debit supplies expense, meaning we've used them, and credit supplies. Depreciation is always debit depreciation expense, credit accumulated depreciation, and they were kind enough to give us the amount. Property taxes for 6 months is estimated to be $17.50. Because they've been accrued, we need to expense them now and pay them later by debiting property tax expense, $17.50, and crediting property taxes payable. The unrecorded, again, it's an accrual, where we're going to receive that interest later, but its income now is going to be a debit to interest receivable, a credit to interest income for the $1,700. The unearned revenue has a balance, meaning cash has already happened, so that's one of those deferrals. So we look at the $1,800 credit balance in the account, and it says services for $600 received in advance have now been performed. So they've been earned, and they don't belong in unearned, they belong into revenue account. So we're going to debit unearned revenue for the $600 that's been earned and credit service revenue $600. And the final one, services totaling $400 have been performed. The customer has not yet been billed, so it's one of those accruals. So send them the bill. Debit account receivable, $400, credit service revenue. Here's some more. As you'll see, there's many examples, and so you're starting to see the patterns coming. So the store supplies account showed a beginning balance of 100, so that's an asset. So on the debit side, we purchased another 700, and the ending balance is 200. So 100 plus 700 is 800 are available to be used. 200 were not used, so we must have used 600. So debit supplies expense, credit supplies. It's a deferral. Depreciation, if you don't know this, you're dead. Debit depreciation expense, credit accumulated depreciation. In C, insurance was purchased for $1,800. It was a 1-year policy, or 12 months. 9 months have passed. So 9/12 have been consumed, and 3/12 are still unconsumed. So we need to move the 9/12 out of the asset account and into the expense account by debiting insurance expense, $13.50, and crediting prepaid insurance, $13.50. Accrued interest on notes payable, they computed the interest for you. It's $50. Since it's a note payable, that means we owe the money, so it's going to be debit interest expense, credit interest payable, $50. Expense it now, pay it later. In Part E, The company received $2,400 in advance, so it went into that unearned revenue account during the year. By the end of the year, 1/3 of that amount had been performed. So 1/3 of 2,400 is 800. So we're going to move the $800 out of unearned and put it into service revenue by decreasing the unearned revenue account by debiting it 800 and crediting service revenue 800, and that increases the revenue account. Here's a new one. Payroll for a 5-day work week to be paid on Friday is $2,500. In other words, 2,500 divided by 5 days gives you the payroll per day, or $500. The last day of the period is Tuesday, so you've used your workers on Monday and Tuesday, even though you won't pay them till Friday. So because year end is on a Tuesday, I need to accrue or recognize the usage of my workers for Monday and Tuesday. So 2 days of $500 is $1,000. So I'm going to expense salaries and wages expense $1,000 because I used my employees Monday and Tuesday, and I'm going to credit salaries and wages payable because I'll pay them later. Expense them now, pay them later. And the final one is services totaling $360 have been performed but not yet received or recorded. So send them a bill. Debit accounts receivable, credit service revenue $360. Now once you make adjusting entries, you'll post them and then prepare an adjusted trial balance to make sure you copy correctly debits as debits and credits as credits. So this is very similar to your second homework problem where you have to make adjusting journal entries. So what did we look at this period? We looked at a lot of adjusting entries. Next video we'll look at closing entries. So adjusting entries was where we spent our time. And we have lots of things that we have learned so far. Things to look forward to is reverse engineering T accounts. So that's coming up right after closing entries.